So there's three levels that you will apply when it comes to accounting, and when you look at the accounting treatment. So like I said, number one is generally applied subconsciously for a transaction you are familiar with. And then we have, so what is number one? Number one is actually understanding understanding what? Number one is understanding the economics of the transaction. What is actually taking place? Okay, so when we say the economics of the transaction, what are all the moving parts? What is actually taking place? Ignoring accounting. You're not thinking about accounting. You're just thinking about the actual transaction happening in real life that you can see or imagine, basically. So for example, if you go to Pick and Pay and you're buying groceries, what is actually taking place? What's actually taking place is that you went into the shop, you packed in groceries into a trolley, you got to the till, and you exchanged. You took groceries from Pick and Pay in exchange for giving them cash. So that is what's happening. From Pick and Pay's point of view, they gave you groceries in exchange for cash. So that is the economics of the transaction. So what happened? They made a sale. How did they make a sale? They gave you they sold you groceries, and in exchange for the sale of the groceries, you gave them money. That is the economics of the transaction. Now we don't think of it like that because it is subconsciously we know it already. So you want to get to that level when it's a complex transaction, what actually took place. So they refer to what are the economics of the transaction. So what actually took place? Pick and Pay gave you groceries and you gave them money. So from Pick and Pay's point of view, they received money in exchange for giving you groceries or selling you groceries. Now we say, okay, that's the economics of the transaction. That's actually what took place. So how do we account for this in terms of accounting? So now you apply two levels of accounting. Number one, you think in terms of the accounting equation. The accounting equation is there to help you identify which elements of accounting have been impacted. When we refer to the elements of accounting, we're talking about assets, liabilities, equity. So remember, when you look in terms of the accounting equation and you want to determine the elements that have been impacted, you start off you start off by asking, was there an impact on assets? Have assets increased or decreased? That's what you're going to have to ask yourself. If the answer is yes, you go to the next question. Have another asset been impacted? Up until the answer is no, or up until the equation balances. So let's say the answer is no, and the equation is still not yet balanced. You then go to the other side of the equation and you start off with liabilities, and you ask yourself, have liabilities been impacted? Yes or no? So have it increased, have it decreased? If the answer is no, and if the answer is yes, and the equation is still not yet balanced, you ask again, is there another liability that have been impacted? And if the answer is no, and the equation is still not yet balanced, then it has to be equity. So if it's not an asset, then you go to the other side of the equation. If it's not a liability, it has to be equity. Why? Because the definition of equity is the residual interest, the leftover, residual interest, the leftover. Um, so residual mean leftover. So equity is the residual interest in assets after liabilities have been deducted. That's the definition according to the conceptual framework. That is why when you think in terms of the accounting equation, you start off with assets, then you move over to liabilities. If there's no asset, no liability, and the equation is still unbalanced, it has to be equity. The only thing you need to think about when it is equity, you need to ask yourself, is it a transaction with the owners, or is it a transaction, or is it a business transaction, meaning not a transaction, not with the owners? That's all you're going to have to consider. So that is the second level. Now you have identified whether you have an asset liability or whether it's equity and what type of equity. Now you go to the third level and ensure your accounting equation balances, the journal balances. That's the only three things you need to think about every single time you come through an accounting transaction. Remember, in most cases, you do it subconsciously because you know it. When you see a sales transaction, you will already go debit bank or debit debtors, credit sales. But you're not even thinking about the transaction because you already know, subconsciously, you already know what needs to take place. But when you come to a complex scenario, then you're going to have to apply your mind in that way. Okay, so get that level of thinking in. So that's all that you need to do when it comes to accounting. So today, we're going to try to apply that as we do the refund liability so you can understand when there's a complex transaction, what is actually taking place. So we will have a look and see what is actually taking place, understand the economics. Now you know what's happening from an economic point of view, then you will say, okay, so how would we treat this in terms of accounting? Okay, and obviously you're going to start with the accounting equation. Once you have identified the accounting equation, your journals, but your journals will be a bit more specific in a way that you will have to classify the various assets, liabilities, and equity. When I say classify, is the asset PPE or inventory? Is the liability, what is the liability? A financial liability, I-37 provisions, things like that. And then under equity, what equity is it? If it's a transaction with the owner, what is it? If it's not a transaction with the owner, what income or what expense is it? Okay, so we're gonna have to get to that level of thinking when it is a complex transaction. But before we go in, and before we do the recap and do part B, I have just some questions. Here's a poll. So I'm gonna launch the poll now. You can just try to answer as quickly as possible, and then we'll get going. There's no right or wrong answer, or maybe there is a right or wrong answer for one of them, but for the rest, there is no right or wrong answer. So I'm gonna give you 1 minute to answer the questions. You should see the poll now, and then select the most appropriate for yourself. Do you see the poll? Yeah, okay. Are you guys gonna vote? Just give you another 60 seconds and I'll end the poll. Only 6 voted so far. Where's the others? Who's wishing they postpone? Okay, I'm gonna end it now. Okay, wait, someone's still voting. Let me just see. 479. Okay. I'll just share the results with you so you can see. So here we can see. Okay, so all of you, so I guess you guys know when there's a separate performance obligation. Okay, but obviously the more tricky part is how do you know it is distinct? So that's the more important aspect. Okay, so no one is feeling great about the revenue. Okay, but there's a few people feeling good. It's quite a few people that is unsure, and at least there's some positivity in terms of they're getting there. Okay, so for test two, you have still 2 days to prep. So whoever did this one, I still have time. I'm going to get there. That's the positivity we want to see. And then for those that wish they postponed, it'll be interesting to know who wish they can postpone. But okay, you still have 2 days. You still have 2 days. Okay. So let's get going. So, so remember yesterday we did, so this is a quick recap because we want to apply these principles tomorrow. Okay, so we want to, I mean, not tomorrow, we want to apply similar principles now in the next part of the question. So when it comes to revenue, revenue is a huge standard, right? It's a big standard. So in terms of accounting treatment, it's big, but also in the real world, it is big. Why is it big in the real world? Remember, revenue is one of the main numbers in your financial statements. In many instances, it determines whether you are a big entity or not. And if you're a listed entity, that is one of the numbers that that analysts and investors and all of those have a look at. They are very interested in the revenue number. If you look at if from an auditing perspective, there are two um, how do I call this now? There are two risks that by default, is considered significant risks by default. There are two items that by default is considered significant risks without you having to assess it. You have no choice, but you have to allocate high significant risk to it. What are those two things? Now, in no particular order. One, it is management override of controls, automatic high risk. Okay, you don't have a choice. You have to select that it is a significant risk because the auditing standard says that management override of controls is by default significant risk. What's the second one? Revenue recognition by default is considered high risk or significant risk. You have no choice. So the revenue number is very, very important for management themselves because that's an ultimately determine their profit, and obviously for top management, revenue also most likely play a role in terms of the bonuses. Um, from an investment analyst point of view, from an investor point of view, revenue generally is a huge number. And also you determine sometimes your market share based on the revenue, and for an auditor as well. Revenue is big. And obviously for tax, because ultimately revenue will impact gross income and so forth. Okay. So the revenue number is huge. So from that perspective, it is big. Okay, so don't take revenue lightly because in the real world, it is a significant number. Then as a result, the accounting treatment will be significant and the accounting standard is also quite big. Yeah, I do send the recordings. I don't have you on WhatsApp. If you can WhatsApp me, then so I can have your number. So I don't think I have your number on in our contact details. Then I will send it to you. Okay. But I sent it out yesterday. But I'll send out an email as well today. I'll send out the email with the recordings of I have both recordings. Um, so so revenue is a big number. Now, from in terms of an accounting standard, they're always going to be very serious on it, more serious than any other standard, or most likely they're serious with everything, but the revenue definitely serious. Now, the revenue standard itself is quite big. Then remember you have definitions and then you have a application guidance, Appendix B, the application guidance. The application guidance is very important for you to read because that's how they show you. They show you how to provide you more guidance on specific issues. Now remember, The main things you're going to be tested on, remember there's different stuff they will test you on, but the main things they will test you on is the 5-step model. Okay, so remember the 5-step model: identify a contract or the customer, determine or identify your performance obligations, determine the transaction price, allocate the transaction price among the performance obligations, and then number 5, recognize revenue either over time or at a point in time. Okay, so that's a 5-step model. Then the specific items that will test you on is a warranty. Remember, a warranty, the big question with a warranty is whether the warranty is a separate performance obligation or not. We discussed that yesterday. How do you determine whether a promised good or service is a separate performance obligation? But in the application guidance, so the separate performance obligation is in the standard itself, right? The standard part. But in the application guidance, which also forms part of the bigger standard, they give you specific details regarding, or they give you specific guidance regarding whether a warranty is a performance or a separate performance obligation or not. Okay, so you need to read that. The other thing they'll test you on is variable consideration. There are two important variable considerations you need to be aware of. One, it would be discounts, as we discussed yesterday. And remember, with a discount, the way you determine whether there is a discount, you first compare the standalone selling, the sum of the standalone selling prices with the transaction price. If the transaction price is more than the sum of the standalone selling prices, there's no discount. If the transaction price is less than the sum of the standalone selling prices, then there is a discount. So then you're going to have to allocate the discount. The discount can be allocated in two ways. Either you allocate it amongst every performance obligation on a pro rata basis in the same way you allocated the transaction price, or if they mention in the scenario that there is a discount for specific items, then you only apply the discount to those specific items. So in this scenario, they told you that the service items, which was data, what was it? Data, voice, and SMSs, they have a 15% discount when you buy the contract or the bundle, whatever. So if the transaction price was less, then there would have been a discount. Then the discount would have been applied only to the service items and not to the phone. Okay, but if they did not mention that 15% and we had to apply a discount, then you apply it across all the separate performance obligations. Okay, so that is one of the types of variable considerations, a discount. The second type of variable consideration that you need to know is loyalty programs. Okay, so this question didn't have a loyalty program, but that is the second thing. So one, warranty. Number two, variable consideration. Under variable consideration, there are various items, but the typical one is discount and loyalty program. The third item we covered was a significant financing component. You will have the question, the way you identify whether there's a potential significant financing component is when the transfer of the promised goods or services does not coincide with receiving the consideration. So yesterday we saw that on the same day that you transfer the data, minutes, and SMSs is the same day you receive the consideration. So there's no timing difference. So by default, there can't be a significant financing component. However, with the phone, it is a 24-month contract. So on day one, when you transferred the full phone, you didn't cut the phone up into 24 pieces. On day one, you transferred the phone. However, the cash consideration received for the phone is going to be received over 24 months. So that gives you, there's a timing difference between the transfer of the promised good or service and the consideration received. The question, now you know there is a timing difference. The question you need to ask yourself, is the timing difference significant? Now you can imagine that 24 months is significant. So as a result, you'll conclude that that is a significant financing component. So you'll have to present value the the portion of the phone. So the portion of the phone that you recognize as revenue will be less than what you allocated to it. And the difference is going to be your interest income that you'll recognize over the 24-month period. So just take note of that. And then we have the fourth item. So number one, warranty. Number two, variable consideration. Under variable consideration, discount and loyalty program. And then number three, significant financing components. You can read the standard. There's some more details regarding significant financing component that will help you. Number four is what we will do today, and that is a refund liability. These are the typical items. There are many, many more. Okay. But it's for you to read the standard. Okay, so we're covering the big ones. I'm not saying the smaller, the other ones are not big. When I say big ones, I'm talking about what typically comes through. Okay, so this is ITC exam, Psycha, and they kind of tested all the big topics other than loyalty programs in this scenario. Because you all have a loyalty program with a cell phone company. So now we're gonna go into part two, part B. I'm going to ask you to read, not the entire scenario, but I want you to read, I think it was point 4. So what I want you to read is, I just want you to read point 4, and then I'm going to read it with you in the same way I read yesterday's scenario. Where is that point 4 now? Yeah, so we only need that computer and data contract. So if you can just read that, should take you less than 5 minutes, and then I will read it with you. And we will, like we broke down each paragraph yesterday before we went into the required, we will do the same over here. Okay, so I'll give you 5 minutes to read, and then I will read it with you afterwards. Remember, you should have received MAC and FACS recordings already, FAC 1, FAC 3. Today, after this lesson, I'll send out FAC 4, FAC 2, FAC 4. Yesterday, I sent out yesterday's recording via WhatsApp, but today I'll email it. So if you haven't received the other ones, let me know, because you should have received it. Okay, so let's read the scenario now. I just quickly get it out. Yeah, yeah. So you should see the scenario now. So they say under number 4, computer and data contracts. Cellular introduced a new type of contract in the 2017 financial year, which bundles a computer, SIM card, and 3 gigabytes of monthly mobile data at a special promotion price of $3.49 per month over a 24-month period, payable in payable monthly in arrears. There is no upfront connection fee. Okay, so in that thing, we do know we are in the 2017 financial year, 1 January, 1 January 2017 to 31 December 2017. So they're saying during the 2017 financial year, they have a new product, or promotion or bundle, whatever it is. So it's made up of three things, a computer, a SIM card, and data. Okay, the monthly fee is $3.49. The monthly fee is $3.49 for 24 months. So you can already work out the transaction price, which is $3.49 times 24. What does that give us? Let's just see quickly. So the transaction price is $3.49 times 24. So your transaction price is 8,376 Rand. Okay, so you can already pick that up. And it's one of the big differences between this one and the My Life contract. The My Life contract is payable in advance, at the beginning of every month. This one is payable in arrears at the end of every month. So pay attention to that. Okay, so what you should know is that in the every month you make a payment, and every month you get data. So basically, on the 1st of January, you're going to get January's data while you pay for January on 31 January. So 1 January, you get the data. 31 January, you pay for the data. You pay the $3.49. Remember that $3.49 will be split between the various performance obligations. So either between computer, SIM card, data, or between computer and data. Okay, we'll see. So that $3.49 is split between the various performance obligations. So your first payment, let's just assume it's happened on 1 January. Your first payment will happen 31 January. But when did you receive the data? On 1 January. So you receive the data at the beginning of every month, while you pay at the end of every month. So 1 month, 30 days difference shouldn't be significant financing component. Okay. But with a computer, once again, they won't cut the computer up into 24 months. They're not going to transfer the computer physically to you over 24 months. Okay, you get the computer up front. So you get the computer on day 1. Let's assume, we don't know when day 1 is, but let's assume day 1 is 1 January 2017. Okay, so let's assume 1 January 2017 the contract starts. So on 1 January 2017, you'd get the computer, the physical computer. But how are you receiving the consideration? You're receiving the consideration over a 24-month period. So that 24 months is quite a big difference. So the timing difference between the transfer of the promised good or service versus the consideration received, there is a timing difference. Is the timing difference significant? 24 months is significant, so that will give rise to a significant financing component. As a result, that allocation price of the computer will have to be reduced for the financing component. So just take note of that. Whereas for the data, you're receiving the data on 1 January, while the consideration is received on 31 January. Okay, so there is a timing difference between when the promised goods or services are transferred versus when the cash consideration is being received. However, you can conclude that that timing difference is not significant. So there's no significant financing component. Okay, so therefore you won't present value the data, but you will most likely have to present value the allocation price of the computer. Okay, so as you read, that is the level of thinking you want to think about. They say the standalone selling price of the computer is 5,000 Rand. The 3 gigabyte of the mobile data are provided at the beginning of each month and can be rolled over to the following month. Okay, so now it's important. You provide data on 1 January 2017. So in the previous example, or in yesterday's example, the minutes, what was it? Data, minutes, and SMSs was only valid for that particular month. Any leftover was forfeited. In this one, you get data for the month. Whatever's left over can be carried over to the following month. Okay. After that, it falls away. So that means you can only recognize revenue for January based on how much of that data was used in January. Because remember, effectively, every month's data can be used over 2 months. So you're going to have to do that allocation. The reason why they do that allocation, it seems insignificant over here. But think about MTN, think about Vodacom, the number of clients they have is in the millions, right? So therefore, the data the data and the minutes and the SMSs that may be carried over relative to these for their clients can be significant. So to avoid, if they didn't allow for this, it would have been easy for management to manipulate when they want to recognize. If revenue is too little this year, they want to push it through this year. If revenue is too little, if revenue is too much this year, they want to push it over to next year. So therefore, even though it seems small over here, in the real world, it is not small. It can have a significant impact. So therefore, January's revenue is basically applicable for January. January's data can be used over January and February. So therefore, cellular will have to decide or have to determine how much of January's data was actually used in January. And they can only recognize revenue for the portion of January's data that was used in January. Everything else will have to be recognized in February. Okay, so just take note of that. So they say the 3 gigabytes of mobile data provided at the beginning of each month and can be rolled over to the following month, at the end of which the unused data will expire. So as you can see, it can only be used over 2 months. Any data of January that has not been used up by the end of February falls away. So therefore, by the end of February, all the revenue relating to January's data can be recognized. The standalone selling price of a 3 gigabyte mobile data bundle is 180 per month. So therefore, we can work out the standalone selling price for the 3 gig data. Because remember, the standalone selling price of the computer is 5,000. So we can work out the standalone selling price of the 3 gig data, which is 180 per month. How many months are there? 24. So 180 times 24 will give us 180 times 24 will give us 4,320. So therefore, the sum of the standalone selling prices, 4,320 plus 5,000, will give you a sum of 9,320 Rand. So you can see once again, the sum of the standalone selling prices exceed the transaction price of 349 times 24. Therefore, there is no discount implied in the situation, even though they call it a promotion. Okay. So just be aware of that. Then they say extra mobile data are charged at normal out of bundle rates as and when used, so that You won't factor into because that is a variable consideration. So that type of variable consideration will be dealt with as and when. Okay, so that's another type of variable consideration, but it's something that falls outside of the transaction price, which is not within the contract. Okay, so here we go into the third paragraph. The contract also stipulates a returns policy. The contract can be cancelled without penalty within the 7 days of signature, provided that no data on the contract have been used. So within the first 7 days, if no data has been used, you can return the thing without needing to pay any amount. If data has been used, I presume the penalty would be that you have to pay pro rata only for the data, if it's within the 7 days. Remember, beyond the 7 days, the return policy is over. Okay, so therefore, after day 7, so for example, let's say 1 January 2017, we sold a computer. So basically, by the end of day 7, effectively, so 1 January, so it's 1, 2, 3, 4, 5, 6, 7. So after day 7, the returns policy falls away. So effectively at the end of day 7 or at the beginning of day 8, you can, the refund policy no longer stands, so you can reverse the refund policy. Okay, so we will show you how to do that. So on day one, you will recognize a refund policy. You will recognize something in respect of the refund policy. Once the refund policy comes to an end, so in this case, after day 7, then you will reverse any refund that has not been utilized. Okay, so just be aware of that. So they say the contract can be cancelled. Okay, we read that. It is expected that on average, 3% of computers will be returned under the returns policy. So what happens on day 1? So let's say we sold 10 bundles, right? So we sold 10 bundles. Now remember, you can't return data because data is being delivered on a monthly basis. So it's only the computer that can be returned. Okay, so what would happen on day 1? We may recognize revenue, right? But on day 1, what we have to recognize is a refund liability of 3%. So we're going to say, so remember it's a refund liability, so we're going to say credit refund liability. So in effect, what would happen, your debtor will be at 100%. I'll show you how we do this, but your debtor will be at 100%, or your cash will be at 100%, but the credit will be split between two. Credit, you can't credit 100% revenue. You're going to have to credit the revenue at 100% less the refund percentage. The refund percentage is 3%. So therefore, your revenue will be credited at 97% and your refund liability will be credited, which is a liability, at 3%. So that is basically how the journal will look. Instead of saying debit bank, credit revenue, you will say debit bank, credit revenue, credit refund liability. Or if it's not being sold on cash, if it's sold on credit, you will say debit, contract debtor, or debit trade receivables, whichever one you want to call it. With that, remember, with a sale comes cost of sale. So in a typical example without refunds, you would say debit, let's assume it's on credit, debit, debtors, credit, revenue, 100%, 100% with regards to the transaction price. And then you will say debit cost of sales, credit inventory. Okay, so we're happy with that, with 100% relative to the cost price. That is your typical sales transaction. With a refund liability, what would happen is that you will have to bring into account the refund liability. So we're going to say debit debtors with 100% of the transaction price, credit revenue. But now, because there's a refund policy in place, you can't credit revenue with 100% of the transaction price. You credit revenue with 100% less the refund liability percentage. And in this case, 3%, so it'll be 97% for revenue and 3% you will credit refund liability. When it comes to the transaction, to the cost of sales, 100% of the inventory left the business. So you're going to have to decrease inventory by 100%. Inventory is an asset, and asset decreases on the credit side. So you'll say credit inventory with 100%, not of the transaction price, but of the cost price. The debit will be split between, you can't debit cost of sales with 100%. Cost of sales and inventory cost of sales and revenue must match. Revenue is at 97% of the transaction price, so cost of sales must be debited with 97% of the cost price. The other 3% relates to the refund, but under cost of sales, the refund under the sales transaction was refund liability. Under the cost of sales, we will call it a right to return asset. Okay, so you will say debit right to return asset with 3% of the cost price. You will see it in action, and I'll provide you with more explanation when we do the journal entry. But I just want you, as you read the scenario, you must already be thinking what this impact would be. Now here we're going to read the last paragraph. The last paragraph now will give you specific details relating to a transaction, and we're going to have to apply the three paragraphs above to this particular transaction. So they say, following a successful credit application, the computer is given to the customer and the SIM card and data are activated. So when the credit application is completed or successful, they will get everything. Okay. Cellular sold 100 contracts on 1 December 2016. It's a little bit strange. They talk about 1 December 2016 because they said this was they only introduced this in 2017. So it's a bit, doesn't make sense. But anyway, Cellular sold 100 contracts on 1 December 2016. Of the 100 sold, one customer cancelled the contract in terms of the returns policy. With regard to the remaining 99 contracts, actual information shows that 75% of the data were used in the first month. So therefore, you can only recognize 75% of the data in December as revenue. The other 25% will have to be recognized as income received in advance, effectively. Okay. And the rest were carried forward to the next month. Cellular purchased the computers for 3,500 Rand each in November 2016. Okay. So what we're going to have a look at, we're going to look at let's look at the required first to see what the required ones. So they say, prepare the journal entries to be processed at December 2016 for Cellular Connect to account for all consequences arising from the 100 computers and data contracts sold on 1 December 2016. Assume there are only two distinct performance obligations in the contract, namely the computer and the 3 gig of mobile data. The cost of the SIM card is negligible and can be ignored. 23 marks. Half of the question, okay, no, not half, but yeah, okay, more than basically half is, so there's not a 40 mark question, this was a 53 mark question. So quite a 23 marks. Maybe you get 23 out of 40 marks tomorrow in journal entries. Hectic, hey? So let's have a look. Let's say round of all amounts to the nearest rand. Journal and nation are not required. Ignore normal tax implications. Ignore value-added tax. Your answer must comply with international financial reporting standards. So they want everything at 31 December 2016 relating to this. So all consequences. Okay, so remember there was a contract, the inception of the contract took place on 1 October. I mean, on 1 on 1 December. We need to have a look what will we recognize at 1 December. Well, at contract inception, we need to decide what will be recognized at 1 December. Okay. Then 7 days later, the refunds policy comes to an end. So we need to have a look what happens after the refund policy comes to an end. The third aspect will be is 31 December 2016 when we receive the cash. Okay, so remember the 349 is going to be received on 31 December 2016 because the cash is paid monthly in arrears. So at the beginning of the contract on 1 December 2016, the computers were transferred, the SIM card and the data was activated. December's data will be transferred or activated on 1 December 2016. The first monthly payment we're going to receive is 31 December 2016. So now we know something happens on 1 December 2016, something happens on 31 December 2016, and also something's going to happen around the 7th, 8th of December when the refund policy comes to an end. Okay, so those are the dates that's going to trigger transactions. So we're going to have to decide. Remember, the way you're going to deal with this is to apply the 5-step model. Step number 1, identify a contract with a customer. There was a signed contract, we're happy, done. Okay. Step number 2, determine the performance, the separate performance obligations. They told us what are the performance obligations: computer, data. Ignore SIM card. So computer, data, 2 performance obligations. Step number 3, determine the transaction price. We determined it already as we read the scenario, 349 times 24. Step number 4, allocate the transaction price between the performance obligations. So in order to do step 4, you must have step 2 and step 3. Whether they ask you for step 2, whether they ask you for step 3 or not, in order to do step 4, you need step 2 and step 3. So we already know step 2, SIM card, data, phone. We already know the step 3, transaction price, 349 times 24. Now you must allocate the transaction price, step 4. How do you allocate? How do you do step 4 by allocating the transaction price? You allocate the transaction price of 349 times 24 between the performance obligations based on the standalone selling prices. And then step 5, this is where the journal entries come in. How do you recognize revenue? Step 5 says you have to recognize revenue. Revenue can either be recognized over time or at a point in time. You first have to test whether you recognize it over time. If it does not meet the criteria for over time, then you will recognize it at a point in time. So the only time you can recognize a transaction at a point in time is if it does not meet the criteria of over a period of time. So what you will know that the data will be recognized over a period of time because we are providing the service as it's being consumed. So if you're providing a service as it is being consumed, then it will be over a period of time. In this case, we are transferring the computer. We have no significant involvement after we transfer the computer. We have no significant involvement. So the computer, we have there's nothing that is being consumed over 24 months. They benefit from the full computer from day one. So therefore, the computer will be recognized at a point in time. So when is this point in time? When the risk and rewards of ownership transfer, which is on 1 December 2016. So on 1 December 2016, we have transferred the 1 December 2016, we have transferred the computer. However, no money has been received at that point in time. The refund policy only applies to the computer, so we will deal with the refund policy at that date. When we make the sale of the computer on 1 December 2016, we will deal with the cost of sales, and because the refund policy only applies to the return of the computer, we will deal with the refund policy also at that date. 7 days later, we will have to deal with the refund policy. Remember, out of the 100 computers, 1 computer has been returned, the rest have not been returned. So therefore, the remaining balance of the 99 will have to be reversed. Then on 31 December 2016, we received the 349. We're going to say debit bank 349. But remember, we're only going to receive 349 for 99 contracts because 1 contract have been cancelled. So on 31 December 2016, it's going to be debit bank 349. The question is, what are we going to credit? Okay, so remember that 349 relates to 2 things. The performance obligation of the computer, the performance obligation of, what now? Of the data, okay? Remember, the computer was already, the revenue of the computer was already recognized on 1 October. Or, yeah, so on 1 October, okay? We have already recognized the revenue. So there's no revenue to recognize regarding the computers because we recognize the computers at a point in time. So all we're going to do is that cash portion that we are receiving for the computer will reduce the trade receivable relating to the computer. The remaining 349 that applies to the data will be allocated as revenue to the data. But now remember, the revenue of the data is not that straightforward. You can't recognize the full portion of the cash relating to the data as revenue because the data is provided over 2 months. So 75% of December's data was used in December. So therefore, only 75% of the premium received can be recognized. The premium received relating to the to the data can be recognized in December, whereas the 25% will have to be recognized as income received in advance. Okay, so just take note as that. So let's see it in action. That's just a high-level explanation. Let's see it in action, and then you can ask me some questions. So tell me once you see, Excel. Okay, you should see Excel now. So just tell me if you don't.
I can see you Excel.
Okay. Okay, so now I'm going to deal with journal entries. So remember, we're going to have debit and we're going to have credit. The first date we're going to deal with is 1 December 2016. The next date we're going to deal with 7 or 8 December. It's not going to make a train smash to make 1 day difference. So let's say 7, because I will recognize it on the 8th of December, because you have to wait for the 7th day to complete, because they have up until the end of the 7th day. So I'll do it on the 8th of December. That's the refund. And then the cash received 31 December 2016. Okay. So remember, in a complex transaction, think of the economics of the transaction. So this is the economics of the entire transaction. On 1 December, you're sitting in MTN. You at MTN, you're sitting over there, right? Or let's say cell C, but this is cell C. They said this is the third largest cellular network, so it must be cell C. So you're sitting at the cell C store in Canal Walk, okay? It takes 20 minutes to do your credit application. They check your credit application 20 minutes later. You took a walk to the food court. You went to go buy some food. You came back 20 minutes later. They tell you that the application has been successful. Because this is on promotion, they'll most likely have all the items in store. So when 25 minutes later, when your application was approved, you can get, they have everything to give you there. So what do they give you? The application has been successful. So at that point, you sign the contract. Okay. So the contract is signed. There, step number 1 is met. You have identified a contract with a customer. Now, the contract states you're going to get a computer, you're going to get a SIM card, and you're going to get data. Because you have signed the contract and they have everything in store, on that day, they give you the computer. Okay, so they give you the computer. At that point in time, you also get the SIM card, and the SIM card is activated right there, and the data is activated right there. On 1 December, you get the phone, you get the computer, you get this an activated SIM card, and you get data that is activated for the month of December. So you have 3 gigs of data on 1 December 2016. That is what takes place over there. From now, that is the salesperson dealing with, or the consultant in the store dealing with that. Let's assume on a daily basis this gets transferred to the finance department. The finance department sees that a contract has been signed for 100 computers, for 100 contracts. So the finance department understands that the 100 computers have been transferred. The finance department understands that the SIM cards have been activated, and the finance department understands that the 3 gigs data for the month of December has been activated on 1 December 2016. The finance department have to decide how they're going to recognize this transaction. They go through the 5-step model of revenue recognition, and they go through the 5-step model of revenue. And on step number 5, they have to determine how to recognize this transaction. On 1 December, computer have been transferred. On 1 December, data has been transferred for 3 gigs. How do we recognize this? The accounting standard says that you first have to decide whether it meets the recognition of over a period of time. So there's about 3 criteria. Any one of the 3 criteria can be met. So if it is being, one of the criteria are if it's being consumed as it's being used, then it is over a period of time. Data is being benefited as it's being used, as it's being consumed. You benefit from the data as you use it, as you consume it. As a result, data will be transferred, will be recognized over a period of time. The computer is not benefited. There's no significant thing we have to do once we give the customer the computer. There's no input from our side after that point. There's nothing significant we need to still modify. There's no installation we need to do. Once we hand over the computer, the customer can enjoy full benefit of that computer. Okay. And from that point in time, it is theirs, or to some degree, it is theirs. Okay, so that means it's not over a period of time. So it does not meet the criteria of over a period of time. As a result, it meets the criteria at a point in time. Something is recognized at a point in time. A promised good or service is recognized at a point in time. If it does not meet any of the criteria, over a period of time. So as a result, we will recognize the revenue. So we will say revenue is an income. Revenue is increasing. If revenue increases, income increases. An increase in income increases profit or loss. An increase in profit or loss increases equity. Equity increases on the credit side. So I'm going to recognize something over here, profit or loss, profit or loss. So I'm going to recognize revenue over here on the credit side. Now remember, there's a refund policy over here. So I can't recognize 100% of revenue. I can only recognize revenue at 95%, at 97%. The other portion, the 3% of the revenue, will be recognized as a refund liability. Refund liability. As you can see, the word liability is over there. So it's a balance sheet number. So therefore we call it, it's going to SFP. So over here will be 97% of the revenue amount relating to the computer. Over here will be 3% of the revenue amount relating to the computer. We're going to deal with the numbers now. So for every credit, there must be a debit. Remember, when you make a sale, the sale can be one of two things, either a cash sale or a credit sale, or a combination of both. In this case, it is a credit sale. Why? The transaction is happening on 1 December 2016. When do we receive cash? We receive cash at 31. Well, the first of the various cash payments is being received on 31 December 2016. So therefore, on 1 December 2016, there is no cash being received. So the full amount will be taken to debtors. In IFRS 15, we call it contract debtors. Before IFRS, why did I say IFRS 16? In IFRS 15, before IFRS 15, we call it trade receivables. Now we call it contract debtors. So contract debtors will form part of trade and other receivables when you look on the balance sheet. Okay, so contract debtors, this is a balance sheet account, SFP. We will recognize it at 100%. So now let's actually go and work out what is the 100%, what is the 97%, and what is the 3%. But before we do that, remember, with every sale, there will be a cost of sales. They never mentioned what inventory system they use. Remember, in accounting, you have two types of inventory systems, the perpetual inventory system or the periodic inventory system. We always assume it's perpetual unless they specifically tell you periodic. Perpetual means you recognize cost of sales as the sales transaction takes place. Periodic means you recognize the cost of sales periodically. So in the academic world, periodic means every year end. But if they don't tell you anything, which they never, if they only deal with periodic and perpetual in first year, so we always assume we're on the perpetual system. So on the perpetual system, we will recognize the cost of sales immediately as and when the sale is recognized. So therefore, 100% of the computers have left. Computers, because it's a normal, the sale of computers in the ordinary course of business. So we know computers is an asset. So the type of asset would be inventory. Because computers is leaving, inventory is leaving. As a result, inventory is decreasing. Inventory is an asset, so assets is decreasing. Assets decrease on the credit side. So we will have inventory. Inventory is an asset, so we'll have SFP. We will credit inventory with 100% with the cost price. This over here is based on the transaction price that is allocated to the computers. The inventory part is we deal with relating to the cost price. Okay, remember they told us the cost price is 3,500. So basically inventory over here will be 3,500 per computer times 100 computers. For every credit, there must be a debit. Remember, the debit will go to cost of sales, but because it's a refund policy, only part of the debit goes to cost of sales. What portion? 97%. Cost of sales. So cost of sales is in P&L. So how much goes to cost of sales? 3,500 per computer times 100 computers. But we can't have all 100, only 97% will be recognized in cost of sales. Why? Because the 3% will be recognized as a result of the refund policy. What do we call this refund? It's an asset. We just say right of return asset. Okay, so that's what you call it, or whatever else you want to call it, but have the word right of return. And it's an asset, so it's SFP. So what do you notice? P&L is increasing by 97%. P&L is decreasing by 97%. So your gross profit is only representing the 97%. That is what accounting is trying to achieve, to match revenue with cost of sales. Okay, so to match revenue with cost of sales. Now we will deal with the transaction price. So the cost of sales was easy. They told you the cost price is 3.5. So it's 3,500 per computer multiplied by 100 computers. So therefore, 100 computers left our business. So the cost of inventory decreases by 100 computers. If there was no refund liability, if there was no refund policy, cost of sales would have increased by the full 100%. But because there is a refund policy, we can only recognize revenue and cost of sales to the extent that we expect a transaction to take place. So we expect 3% to be returned. As a result, the fair value of revenue should only represent 97%, what we expect to be a sale. So that's important. Okay. So let's do the calculation. Let's do the allocation so that we can actually determine what is the split. Okay, so let's have working one. So remember, we're going to need our performance obligations, or let's first work out the transaction price. So transaction price. Okay, so the transaction price is basically 349 multiplied by 24. Okay, 24 months. So therefore, okay, maybe let's do this. So this is equal to 349 times 24. Okay, so the transaction price is 8376. Now we need to split this transaction price between our performance obligations. So performance obligations is identified in step 2 of the revenue five-step revenue model. The performance obligations was provided to us in the question. So performance obligations. It was the computer. That is a distinct product, and it was, what was the other one? 3 gig data. Okay, so that is our performance obligations data. So now we can have our stand-alone selling prices. Stand-alone selling prices. Our stand-alone selling price for the computer is 5,000 Rand. Data is equal to 180 Rand per month, because the contract is 24 months, so we multiply by 24 months. So therefore the total would be the sum. So the total would be the sum. Okay. So we just put in the transaction price over here. Transaction price. So here we can conclude, is there a discount? Is there a discount? The answer is no. Why? No discount because the sum of the stand-alone selling prices exceeds the no wait, is there a discount? Oh, there actually is a discount. So it is actually a discount. Is there a discount? The answer is yes, because yes. Is there a discount? Yes, because so there is a discount because the transaction price is less than the stand-alone selling prices. Okay, so just take note of that. So there is actually a discount built into here, but we don't need to factor in the discount. The reason being is it's allocated across both performance obligations. You only need to allocate a discount if it is if it relates to a specific performance obligation. So we will say no need to allocate the discount because the discount is applicable to all performance obligations. If the discount were only applied to one of the performance obligations, then we'd have to make some additional allocation. Okay, but because it applies to both, we're going to end up with the same number. So there's no need to do an allocation for the discount. So please take note of that. I know earlier if you can watch this video, you're going to see that I made mention that there's no discount, but my brain wasn't thinking straight. So there is a discount when the transaction price is less than the sum of the standalone selling prices. If the transaction price is more than the standalone selling prices, then there is no discount. So here there is a discount, but we're not going to allocate it because it's going to be allocated across all the performance obligations. We're going to end up with the same result. The only time we allocate a discount specifically is when a discount applies only to one or a few of the performance obligations. So now we can allocate the transaction price, TP for transaction price. Let me just maybe do it here. So now we're going to allocate the transaction price. So how do we allocate it? Remember, we allocate the transaction price based on standalone selling prices. So we're going to say 5,000 Rand, which is standalone selling price, as a percentage of the total standalone selling prices multiplied by the transaction price. So 4, whatever that goes to there. So if we add this up, this must add up to the transaction price, which it does. Now we can ask ourselves, significant financing component. Is there a significant financing component? Remember, with the computer, the answer is yes. With the data, the answer is no. So how did we determine this? We said you compare when the promised good or service is transferred, and you compare that to when a consideration is received. For the computer, the promised good is transferred on 1 December 2016, and the consideration is received over a 24-month period. So is there a timing difference? The answer is yes. Is the timing difference significant? The answer is going to be yes, because we receive the money over 24 months while we transfer the asset on day one. Not the asset, the promised goods or service on day one, while we receive the consideration over a period of 24 months. That is a significant financing component, so therefore we said yes. With the data, we transfer the data every month over a 24-month period on the first day of each month. We receive the cash for each month at the end of the month. So data of December is transferred on 1 December, while it's being received, while the cash is being received on 31 December. Is there a timing difference? The answer is yes. Is the timing difference significant? 1 month, 2 months? No. So therefore we conclude that there's no significant financing component. So therefore we're going to have a new allocation. Okay. So therefore we're going to have allocation after significant financing component, and then we can work out, and then you can just have it, no need to have the last column, but we'll just say the finance component. No need to have this column. The finance component is simply going to be what was allocated before financing versus what is allocated after financing. Okay, because there's no significant financing component for the data, we will just provide it like that. Now we're going to have to deal with the financing component for the computer. We did something like this yesterday. Given the scenario, I'm going to give you 5 minutes to try to work out the present value of the computer. So I'm going to give you 5 minutes if you can try to calculate it using what we dealt with yesterday. So I'll give you 5 minutes. Okay, so let's work out the financing component. So remember, what are we trying to work out? We're trying to work out the present value. In order to work out the present value, we're going to need the future value. We're going to need PMT. We're going to need N, and we're going to need I. Okay, so we're going to need N, and we're going to need I. So what we're trying to work out is our present value. So just take note of that. Okay. So remember, your future value is the lump sum payment at the end of the period. There's no lump sum payment at the end of the period, so that's going to be 0. I'm going to work on a total basis, so the full 349. So for the phone and for the full premium. So the monthly payment is 349. Okay. How many payments in is the remaining number of periods or the remaining number of years times the number of payments. So the number of years is 2 multiplied by number of payments per year is 12. We know there's 24 payments. Okay. They told us in the scenario, it is 9%. But 9% is per annum. So we need to divide this by the number of payments per annum. There are 12 payments per annum. So therefore, the present value would equal PV rate is 0. Whatever that is. N is that. PMT is that. Future value is that. Remember yesterday, we also did a present value calculation, but payments happen at the beginning of the period. So the type was 1. And you had to ensure that your financial calculator was converted to be the beginning of the period. Now, in this case, payments happen at the end of the month. So therefore, it must be end of the period. So you must make sure your calculator is in default mode, which means you shouldn't be seeing BGN on your display. If you see BGN on your display of your financial calculator, it means cash flows is happening at the beginning of the period, and that should not be the case in this one. So I'm selecting 0 for end of period, and there we go. So that is the present value of the total transaction price. Now we need to, so this is the PV of the total transaction price. So PV of transaction price, I'm going to convert it into making it positive because we know the present value generally comes out negative if your future value is positive, because future value and PV is in the opposite direction. So the present value of the transaction price is 7,639. Now we can allocate between computer and data. We don't really need to have it for data because we only want it for computer. So basically, the computer is, we know it's 5,000 Rand, standalone selling price, divide by the sum of the standalone selling prices, multiplied by the present value. So therefore, the present value of the computer is 4098. 4098. So basically the financing component that we're going to recognize over 24 months is going to be 395. Okay, so over 24 months it is going to be 395. So you can kind of work it out by saying divided by 24. That will most likely be, but we will see how to work it out just now. Okay, we can't actually work it out like that because of the and remember the monthly transaction, that is the total data over 24 months. So on a monthly basis, it is that amount divided by 24. So our monthly amount is effectively 162. So now we can deal with our debtors. So remember, the revenue is going to be 97% of the transaction price, but it's not going, it's going to be the one after the significant financing component. So it's going to be 4098. That is the price, the transaction price allocated to the computer after the significant financing component, but that's for one computer. So we're going to multiply it by 100 computers. So we technically want to recognize that full amount, but we can't recognize the full amount. We can only recognize 97%. So that is how you're going to calculate it. Over here, if I can just drag that up and drag this down, it's going to be exactly the same, but debtors, the 100% goes to debtors. For refund liability, 3% goes to refund liability. So if I work out revenue, revenue is going to be the amount after the significant financing component times 100 computers times, we can't recognize the full 100 because there's a refund policy and 3% of computers are returned. So therefore, the best estimate of revenue that we'll be earning is 97% after the expected refund. So this is going to be, I'm just going to go fetch that number. So 4098 times 100 computers times 97%. Over here, contract debtors is going to be the 4098 multiplied by 100 computers multiplied by 100%. No need to put in 100%. I'm just including it so you can understand what we are doing. And the difference over here is going to be the 3% for the refund policy. I just want to show you, don't have to show this in the exam. I'm just doing it for our purposes. I'm only doing it for our purposes to see that the journal entry balances. Okay. So the journal entry balances, that's what we want. So on 1 December, we are recognizing the revenue relating to the computers. Why are we recognizing revenue relating to the computers? Because on 1 December, the computers we recognize at a point in time. So we recognize revenue for the computers only. We do not recognize revenue for the data because data is recognized over a period of time. So at the end of every month, we will recognize the revenue for data. Why? Because that is when we have provided our part of the obligation. We have provided our service. But with the debtors, with the computers, we have provided our part on 1 October when we gave them the computers. So therefore, we can recognize the revenue for all the computers on day 1. So if there was no refund liability, it would simply been debit contract debtors, credit revenue, 100%. But because of the refund liability, revenue must be split between the refund liability and revenue. Why? Remember, you want to recognize revenue based on the best estimate of revenue being earned. So based on past experience, 3% of sales are returned. So effectively, for every one sale, you only make, for every 10 sales, you're only going to make seven sales. So even if you make 10 sales, you need to, not say, sorry, for every 100 sales, you are making 97 sales. 3 sales are being returned. So therefore, you can only recognize revenue to the extent that you expect revenue to be reliably earned, okay, or probably earned. So just keep that in mind. That is why we bring it like this, okay? And because you're recognizing a revenue at 97%, cost of sales must also only be recognized at 97%. Okay, so just take note of that. Now we're going to deal, before we go on to the transactions on 7th, 8th December, do you have any questions regarding to the transaction at 1 December 2016? Anyone? No?
No questions.
No questions. Okay, so now we can move on to the refund policy. Okay, so remember what happened what happened at 7 December. So I'm going to do the bit on the long way so you can just see each transaction separately. So on 7 December, or within the refund policy, we don't know when this person returned, but they returned it within the returns policy. So basically, you can have this date 7 or 8 December. Okay, I just chose 8. So let's deal first with the person that returned. When they returned the computer, they no longer owe us for the computer. They no longer owe us for the computer, so therefore debtors needs to decrease. Debtors is an asset. So assets is decreasing. Assets decrease on the credit side. So I'm going to have contract debtors. I'm going to have contract debtors that is going to be credited for one computer. We know one computer is equal to 4098. Okay, F32. Okay, so we know one computer is 4098. So therefore that one debtor needs to decrease. This debtors represent 100 debtors. Now that we are crediting debtors for one, debtors is now going to be at 99 debtors, what we want. Okay, now remember, we have recognized a refund liability for 3 returns. Okay, one person returned, so therefore we can have refund. We can reduce the refund liability because we have estimated 3 people to return. One person only returned, so therefore when we decrease contract debtors, we can decrease refund liability because we have set aside 3 returns, one person returned. So therefore with refund liability, SFP, refund liability is a liability. Liabilities is decreasing by 1. So therefore, and liabilities decrease on the debit side. So therefore I can decrease it on the debit side. So there, that transaction balances. Remember, with a refund comes the cost of sales aspect, or the right to return asset. We have raised a right to return asset for 3 computers. 1 computer was returned, so therefore that asset is sitting at an estimate of 3 returns, we need to now reduce it to 2 returned because one person actually returned. So therefore, assets is decreasing. Assets decrease on the credit side. So for right of return asset, we need to decrease it by the cost price. So the cost price that we're going to reduce it by is 3,500 times 1 return. By the customer returning the computer, our computers are going up. Computers is, we sell computers in the ordinary course of business. Computers is an asset. The type of asset it is inventory. So inventory is increasing, assets is increasing, assets increase on the debit side. So we have inventory. We have inventory, SFP, with the same amount. So that is dealing with the right of use asset. As you can see, no impact on profits, okay, because we have recognized it already. So no impact on profits because remember, we have reduced profits already by only recognizing 97 items. We have not recognized 100 items, so there's no need to reduce profit. If, however, we have allocated a refund for 3, but 4 people returned, we can only take 3 against the refund, and the extra 1 will then have to be impacted against the profit or loss line items. So I must just be cognizant of that. Now remember, 1 person returned. The refund policy is now over. We don't accept any more returns. So therefore, there is no need to anymore have, there is no need to have any more the refund liability and the refund and the right of return asset. Okay, so now we're going to have to reverse that. So there's a message that came through in the chat. I will check it now. So now that the refund policy is over, we no longer have an obligation to make a refund, and we have no longer a right to receive the asset. Okay, so what's going to happen? The refund liability is going to decrease. The refund liability is going to decrease. The refund liability is going to decrease. So therefore, liabilities are decreasing. Liabilities decrease on the debit side. So what are we going to debit it by? Remember, with the difference. Basically, this represents 3, okay? But 1 person returned already, so there's only 2 left. So what we're going to do is just basically going to be that minus that. Okay, so it's so basically, if we add up, the refund liability is now at 0. Okay. So we're reversing the 2 estimated returns that we're reversing 2 of the 3 estimated returns that was not returned within the refund policy period. Okay, so just take note of that. Now, the question is, what is the credit? Over here, we credited contract debtors. Why could we credit contract debtors? Because the customer actually returned it, so we have no there's no right to receive the cash from the customer. So we can't anymore have a contract debtor. With this, the customers did not return. We only reversing the refund liability because customers can no longer return. So therefore, we still have the right to receive the cash. So because we're not going to be refunding those computers, we have a right to so basically we have now actually earned the revenue. So now we can recognize the revenue after the refund policy has been after the refund policy has come to an end. So therefore, we ultimately now, by recognizing this transaction, revenue is now recognized for 99 computers. On day one, we recognize revenue for 97 computers. On day, because we expect 3 computers to be returned. But once the refund period is over, we will recognize revenue to the extent that of total sales less refunds. So therefore, total sales was 100, refunds was only 1. So revenue should represent 99 sales. By recognizing revenue for these 2 sales, we have revenue now at 99 sales. So this thing is important because if you get a situation where we expected 3 returns, but we had 4 returns, after this policy is over, we would expect revenue to only be representing 96 sales. So just take note of that. So think in terms of that. Once a refund policy is over, you want it to represent actual sales. Actual sales is 100 versus what was actually returned, 1. So actual sales should be 99 sales. So now you are recognizing revenue at 99. It is the 97 plus the 2, which represents revenue of 99 sales. So see the logic between it, understand the economics of the transaction, and then put that into place in terms of what accounting is expecting. So with that, once again comes the right of return asset. We no longer have a right of return. So therefore, we no longer have a right of return. So right of return must decrease. Right of return is an asset. Assets decrease on the credit side. So we're going to decrease 3,500 cost price times 2. And we can't debit inventory. Over here, we debited inventory, but we can't because we never received the computers was not returned. So therefore, because we recognize revenue, we have to recognize the corresponding cost of sales. So what after the refund policy, we have revenue recognized of 99 sales. So therefore, cost of sales must also represent 99 sales. At this point, cost of sales represents 97. Now with the 2 extra, cost of sales represents 99 sales. Okay, so I hope that makes sense. So that are the journal entries at 8 October or 7th October, I'm sorry, at 8 December or 7 December. What you can do, this transaction with this transaction can be combined into one. Okay, so I'll just highlight it in orange. This transaction with this transaction or journal can be combined into one. I'll just highlight it in yellow. So you can decide what you want. I only separated it in terms to bring across the thinking process. But once you have the thinking process going, you can combine the 2 orange, you can combine the 2 yellow. So I just went the longer route. Okay. Now on 31 December 2016, now we will recognize what takes place on 31 December 2016. Okay, so I'm going to check the chat. What's the question? How did I get the rate of return asset? The rate of return asset, the cost price is 3,500. 3 items is going to be returned. So 3,500 times 3 items gives you a rate of return of 10,500. So when one item is returned, we just use the one cost price of 3,500. Now we will deal with the cash amount. Okay, so now we will deal with the money that that's being received. So on 31 December, money is coming in, cash is coming in. We take cash to bank. So bank is increasing. Bank is an asset. Assets increases on the debit side. So we're going to say bank, and we're going to debit bank. Bank is SFP. We're going to debit bank with the monthly premium. We're going to debit bank with a monthly premium. Remember, the monthly premium is 349. But after the refund policy, we no longer have 100 customers. We only have 99 customers. So bank is going to increase 349 monthly premium times 99 customers. This amount, this 349, is for 2 performance obligations. This 349 is for 2 performance obligations. Okay. Of the 349, 160 whatever, 162 relates to the data. So therefore, we can recognize revenue for the data. So when you say credit revenue, P&L, for the data, it's going to be 161.77 multiplied by 99 contracts. So 161.77 times 99 contracts. Okay, so remember, of the 349, 161 represents the data. So 161 multiplied by 99 contracts will give you the revenue for the data. But what do we know? Not all the data was used in month 1. Only 75% was used in month 1. So therefore, we must multiply this by 75% to recognize the revenue that we have earned in month 1. So if I say equal 161, or you can say 388.22 divided by 24. That is why I just did it over there. 161 multiplied by 99 contracts, because 99 people paid us. But remember, we can't recognize the full 100%, because only 75% of the data was used. So therefore, we'll say times 75%. The other portion, of this 161 multiplied by 99 people multiplied by 25%, that will be income received in advance. Okay, so we'll see what's the proper term they used. It's no longer called income received in advance, but I'm just going to call it for now income received in advance. Why is it income received in advance? Let me just explain this. At 31 December 2016, we received money of 349. Of the 349, 162 relates to data, and the difference relates to the computers. Okay. Now, all at once of the data, so remember 161 or 162 relates to the data. The difference relates to the computers. Now, let's just focus on the 162 that relates to the data. That 162 represents the data that we provide in the month of December. But what do we know? The data that December's data can be used in December and January. Therefore, we can only recognize December's data to the extent that they have used December's data. They have used they've used only 75% of December's data. Therefore, the premium of 162 relating to December can only be recognized to the extent of 75%. The other 25% can only be recognized in January when we provide the service. How do we provide the service? When the customer uses the data. So just take note of that. Okay. So the balancing figure is 349 minus 161. So 187.23 of the 349 relates to the contract. But just take note, we need to deal with it in a different manner. I will show you now. 161.77 times, yeah. So now the difference, all that's going to happen is that the difference goes to contract debtors. Okay, so the difference relates to contract debtors, the computers. So what is the difference? So just have a look. The difference is simply going to be that. So the difference is going to be that 8,536. Another way to have calculated it. So another way to have calculated it is simply going to say equal 187 multiplied by 99. So there we go. Okay. So 187 times 99, that is the balancing figure. Because remember, of the 349, 161 is for data. So therefore, the other portion can only be for the computers, which is only 2 performance obligations. With the 161, we didn't recognize the full 161 in December because only 75% of the service was provided. The other 25% will be provided next month. So just take note. That is why we split this between what was provided and what must still be provided. Okay, so just take note of that. Okay, so income received in advance, SFP, contract debtor, SFP. Now remember, there's one more transaction we must recognize on 31 December, and that is the interest income. So we're going to say interest income has been earned. So income is increasing. Income increases profit or loss. Profit or loss increases equity. Equity increase on the credit side. So interest income is going to be credited. It is a profit or loss line item. So we have to increase interest income. So the way we increase interest income is simply going to be by the present value of the, so simply going to be by the present value. Let's just do this quickly. It is simply going to be by the present value of the computers multiplied by 9%, the interest rate that we used to get the present value. But remember, this is only for 1 month, and that 9% represents a year. So we're going to say 1 divided by 12. But remember, 4098 represents 1 computer. There was 99 computers. So once again, 4098 is the present value of the computers. How do you work out interest income? Present value times the interest rate. The interest rate used to get to the present value was the 9%. So you must use that interest rate. You use the interest rate that you have used to get the present value. So it's present value times interest rate. So present value of the computer, 4098, times the interest rate used to get the present value, which is 9%. But that 9% represents an annual figure. We only recognizing interest for the month of December. So therefore we say 1 divided by 12. But at this point, this represents one computer. We have 99 computers. So therefore, we say multiply by 99. So it's equal to 4098 multiplied by 9% multiplied by 1 divided by 12 multiplied by 99. Okay, what it could it also have, should also work as follows. The monthly figure over here, because remember that 395 divided by 24 times 99 should give you the same. Does it give you? Multiply by 2 and then multiply. Let me just see if it gives. I don't know if it gives you the same. No, it doesn't. So you rather use it that way. So rather use it this way. Okay, so you take the present value times 9% times 1 over 12 times 99. Where does it go to? For every debit, there must be a credit. It's not bank. Can't go to bank. It will go to contract debtors. So the contract debtors owes us for the interest income. So that's basically how this transaction will look. I'm just going to do this. You don't need to do this summing up of balancing. I'm just doing it for our purposes to show that the transaction balance. Okay, so that is basically it. Do you guys have any questions? So that is the 23 marks of the transaction. The only way you're going to get to grips with it. So here is 2 suggestions. Number one is the suggestion I showed you. You use it together, right? So what is the suggestion I made mention? Understand the economics of the transaction. Then you apply the accounting equation, and then you make sure that the journal balances. Okay, so that is how you actually think through an accounting transaction. To make it more practical is, as you can see, we have different dates over here. So you kind of draw a timeline for yourself and you look at all the various dates that the transaction takes place. And in words below each timeline, you'll tell yourself on 1 December, what takes place. On 7-8 December, what takes place. On 31 December, what takes place. On a piece of page, draw a timeline. You don't have to draw a fancy thing. A timeline is a line with different dates on it. Okay, so here's 3 dates. 1 December, 7-8 December, 31 December. Under 1 December, tell yourself what takes place and what would be the accounting treatment. On 7-8 December, what takes place? What are the accounting treatment? 31 December, what takes place? What is the accounting treatment? That is how you're going to deal with it. That method is going to become extremely handy for test 3. In FAC 2, FAC 4, when you deal with change in ownerships. The way you're going to deal with change in ownerships is to actually understand what happens on the timeline. And for CTA 2 guys, that's going to come extremely handy with the timeline when they're going to combine change in ownerships with foreign subsidiaries. Lots of things is going to take place when you have change in ownership with foreign subsidiaries. So same thing over here. Start now. When there's complex transactions, break it down. Draw that timeline, because in accounting, transactions happens based on dates, okay? And based on what actually happens at a particular date. Some dates something happened, but it draws no accounting treatment. And other dates when something does happen, it does draw a particular accounting transaction. So just take note of that. So the way you can see how I dealt with it over here, when I looked at the transaction, I'm like, okay, we know something happened, we transfer computers. So on 1 October, what is the accounting treatment based on the transfer of computers as well as the activation of data? On 7th, 8th December, we know the refund policy comes to an end. Does it draw any accounting treatment? Okay, so we saw it did. Then on 31 December, nothing was made mention, but we know on 31 December payments take place. So therefore, recognize the payment and how and what are the necessary accounting treatment as a result of the payment. Now, not forgetting that there was a significant financing component, we need to recognize the finance income. Okay, so that's all from my side. Do you guys have any questions from your side? Let's have a look. Andile, Ashita, Faid, any questions your side?
No questions.
How do you find, Faid, how did you find this transaction, 23 marks?
Too much work, but yeah, I'll see. I'm going to revise it now after the lesson.
Okay. Andile? So those who are going to put in the chat, just quickly, I'll talk to you now. Those are going to put in the chat. If you have any questions, you can put your question, and then just one more thing. What did you find confusing or challenging? Andile, you can go.
Yeah, I kind of quite challenging, but I think through more extensive work through the illustrative examples, I think I'll be better, because for me it was just it was the cost of sales portion and the interest at the end that actually kind of confused me a bit.
Okay, so
overall, yeah.
So the cost of sales, what is confused with the cost of sales?
In terms of the cost of sales, it was the return or the rights of the return of assets.
Okay.
Actually taking that account of that. And then in terms of the interest was, I actually totally forgot about the significant financing component.
Yeah. Most people are going to forget about it. Most people are going to forget about it. So now you know that you kind of forgot about it. So now you need to either mentally, like right now, mentally make a mental check and repeatedly tell yourself, if there's a financing component, don't forget interest. If there's a financing, don't forget interest. Or if you're not going to remember it mentally, still tell yourself mentally and write it down. Like there's a strategy that some people use that every silly mistake, right? So when I say silly, it's like something you would have gotten right if you remembered, or whatever it is, maybe a calculation or something. They kind of write it down. So they have like one page of all the common mistakes. So before they go into the exam, they just read that page so that it's kind of fresh in their mind. So you just want to keep on reminding yourself. Another way is to make it big on your question paper. So you need to just come up for yourself how you're going to remember it. With a contract, with a right of use asset, with a right of return asset, when there is a refund liability, your journal entry is going to be credit revenue. With a refund liability, your journal entry for the cost of sales part is going to be credit inventory 100%, credit cost of sales with 100% less the refund part, which was 3%, and the right of return asset is going to be debit 3%. So your debit is going to be split between cost of sales and the right of return based on what is the policy of refund. So we know the policy of refund is 3%. So cost of sales will only be recognized to the extent of 97%. the percentage of cost of sales must equal the percentage of revenue because you are matching revenue with cost of sales. So, and then the right of use as the return of asset is basically the cost price. So that is all that is taking place. You can effectively, if you don't get it, memorize a journal entry. But at some point you want to understand it, okay? Because they can complicate it if they want to. When I say complicated, just the calculation. So you want to understand it. Ashita, anything confusing? Fakir, Mutanga, and Rebecca, any questions? Anything confusing? Fakir, Mutanga, Rebecca, anything confusing? Ryan, any questions? Anything confusing?
Hi, no, nothing specific at the moment. But I'll maybe message you or in the group if I have
Okay.
any further
Any
questions.
questions? That's fine. Fakir?
Yeah, probably question is maybe at the allocation part, we further needed to allocate the financing portion. That maybe confused me because only the normal allocation like we usually do. We take the transaction first.
So you get that, what you call it. So maybe try to work through yesterday's one and today's one, but there was both significant financing components. Then if you still struggle, then just message in the group. Okay. Because like if it's like a general question like that, send it in the group because it may benefit others. If it's a highly specific question, then you can, what you call it. If you're not certain, you can send it to me privately, but then I will then just copy it and put it in the group, and I'll respond in the group if I feel it is something that will benefit everyone. So I know most of you prefer sending it privately. So you can send it privately, but if I feel it is going to benefit everyone, I will respond to it in the group. Okay. Okay, so the significant financing components, I see people struggling on it still. What I'm not going to deal with it further now. So try to work through yesterday's one and today's one. And then if you still have a problem by 5 o'clock today, send it to me so that I can provide something this evening or tomorrow morning early to further explain it. But it's a typical thing because it's quite often in the real world. Okay. But then anyway, guys, all the best for test 2. Revenue can be challenging, but this is a very challenging question. It was a Psych ITC past paper that UNISA adapted it a bit. I looked through both some time ago when I was going through revenue some time ago, I think the beginning of the year. I can't recall actually what was actually adapted. It seemed like nothing was really adapted. They just kind of said it was adapted. So I'm not, so I don't know what was actually adapted. So I had the ITC, the actual ITC one as well. So I just compared the two. So there wasn't I don't recall anything specific that was adapted. I can't recall it right now. So you can see that in ITC it can be challenging, but it covered basically all the big stuff other than loyalty program. Okay. So maybe when I look at the loyalty program, if you have any questions, you can let me know. Okay, but the loyalty program is not that challenging as well. May seems confusing, but it's not as challenging. It's somewhat treated similar, not the same, similar thinking, slightly similar thinking to a refund. Okay, but anyway, guys, if you have any questions, just message me or message in the group, and we'll help you resolve it. All the best for test 1 or for test 2. Remember, don't overthink, don't panic also too much, but as much as you need to know your content, you also need to know exam technique and to manage your time. So make sure you have a way of managing your time and how you're going to set out your solution and what workings you're going to do, and all. So things that was in your control, try to sort that out now. For those of you that did nicely in test 1, that's obviously going to be a positive for you, because it's going to help you for your year mark, for your exam entrance. But for those that need to brush up, just make sure you give this your best shot. Okay. See you guys. All the best.